All right, good morning. Let's get ready to go. Holiday week, Black Friday week. Historically, one of the lower volume trading weeks, but things are looking pretty okay out the door. How y'all doing? Hit that like button. Let's go, Scooter Squad. You guys ready? Take on the markets today. That like button's get ready to get going. We start in about 4 minutes. Taking a look at the news today, see if there's anything worth chatting about. Volatility's been in the K for the last since we rolled into the new month. Effective Fed funds rate 3.83%. Overnight, European markets are looking pretty stable. If you guys haven't checked out the Rocket Scooter free trial, head over to the website, link in the description, and hook yourself up for the free trial. You will not be disappointed. Promise you that. See what you're missing out on. All right, let's get ready to get going. What's up, friends? All right, let's chair situated here. Whew. Like half asleep. Had a good night's sleep though. To bed early, which is like 2-ish. In my world. How are y'all doing today? Can HP and MHP be calculated prior to the cash session? They cannot. They cannot. This is part of the trick. It has to be when the market opens. Has to be. We have an overnight version called dynamic hedge pressure, which estimates where hedge pressure should be in the morning. It's in our overnight pivots for futures traders. You want pre-market. The overnights are amazing. There's a video on dynamic hedge pressure. Let me send it to you guys if you want to check it out. It's what you can do overnight, and because of the way that the mechanics of this works, this video will go over everything. This is when I trade futures. That's all I do. I use that. Market opens in 4 minutes. To get the pre-market check, we have our rational, irrational signals we look for. Make sure you guys head over to the Discord, rocketscooter.com. Take a look at what it is we're doing over there. We are opening in the rational side of the market, rational bands. I don't know what happened to my RTY, but let's get it back up there. Where's that thing at? Oh no. So the band back on there is there. Why are you not showing up? Zoom out. Oh, there it is. Okay. I was wondering where it was. Okay. These are nice and stable. Let me double check that I have the right number there. 30.4. We're going to go to the Discord. Those numbers you get from our bot in the Discord. It's a calculation that is done once a week. And these numbers 32. I put in 32 right here as RTY. Let me double check here on the S&P that I got all the right numbers in there. 29.50. 109. See, that's exactly. Knew it. It looked off. Okay, 109. Good. I'm gonna put these in manually one at a time. So this is Think or Swim. We're getting this put into Rocket Scooter as fast as possible. 29.50. Okay, that Doomsday band inside market's rational. Rational VIX is not in any kind of move. Rational. We're not doing any kind of market catalyst today. Market's rational. Things are looking good. We're just going to look for hedge pressure breaks and UVXY. 5 signs. And somebody asked me yesterday, they go, you know, what happened yesterday because of this signal this way and the signal like that way? Market was irrational within an hour of opening, and we passed through mean reversion. Anytime you go into a balanced market, markets are random from there. I'll find a way to explain that a little bit better if you can. With these knowledge bombs coming through, hit that like button. The market opens in 1 minute. Let's go. Daddy's gonna check his Celsius real quick. Do not like mango passion fruit because I like either mango nor passion fruit that much. Passion fruit, the least of all fruits. Blech. I bought a case of it. Gotta burn through it. Okay, market is officially open. Let's go. See what we get. Some of you brought up some questions about yesterday's data. Data is okay. Monthly hedge pressure on the start of a trading month, which is the 4th Monday of the month. Believe it or not, if you guys are writing down, taking notes, the 4th Monday of the month is first day of the month, trading month. And I don't know if you guys, is the music too loud or is the music good? Because I cannot hear myself. If it's too loud, let me know. I'll turn it down. You ready for stuff to go ahead and be able coming through here? We're going to watch those initial prints. Oops, I'm going to go ahead and log out and log back in. You can barely hear it? Okay, perfect. Make sure I log into my platform here. My password is... Rocket Scooter is awesome. You should join. Let's type that in really quick. Boom. All right. Logging back in. Let's get the double checking the timestamp here because people were asking yesterday. Timestamp is perfect. Remember, we are getting monthly hedge pressure very low. That is normal. Bull market. Very normal, actually. As a matter of fact, it's making me happy to see it like that. And people are saying, I don't understand why is monthly hedge pressure so low? And that's how it is. In a bull market, it's very far away on the first day of the month and starts to collapse in even 30 points. We've seen it bigger. Not reason for alarm. People say, well, it's unactionable or anything. Yes, this is exactly what happens when the market is building up a very bullish position. It's a bit low, but it's okay. Oh, let's turn it up. Taking some theta decay on all my positions. I still have my Google, still have my Qs. Nothing's changed. Nothing's changed. They're taking some heat because they need to strike. I've got December 9th expiration. No hurry on that. If we get another big run up, I'm going to decide if I want to push them out, keep them, or whatever. Been sitting back on that. Modelo Gelada mix pack is amazing. I actually have, it's funny, we had a game night the other night. We had Modelo Gelada mix. That's the drink that we made, Geladas. So I still got a whole bunch of all that left over, just generally. Like not even, there's a Celsius that's Gelada flavor. That's pretty good. All right, let's start out. Bear short up, bull short up. Let's go. Let's go all the way to liquidity map. Let's take a look. Bull short up. BSU has that monthly hedge pressure support and that hedge pressure break push. This is really interesting to see. Let's take a look at resilience out the door. Very positive. So today on the BSU, we have support at the gap. Half gap is good. As long as resilience stays positive, we are good on that. 396.5 break is looking pretty okay. If we do get that. So let's take a look in this BSU, the lowest call on the zone means today I'm expecting 395 to be support. If we get any kind of bounce here, that is a bull bounce. If there is one from here to here, very small probability you do break through hedge pressure and go, but you can with volatility and decay. It could be very possible. In mean reversion, this is random. This happened yesterday. Within 5 minutes of market open, you go through a liquidity pocket. When you touch this, you should not trade that instrument anymore through technical indicators or anything else. Once the imbalanced market has found balance between the two zones, we statistically have proven that it's random. And this happens a lot. And a lot of people come in chat and say, Matt, I'm curious. Resilience did this, or this other thing did that, or this one thing looked like this. And I don't understand. And I say, is the market random? Well, yes. The minute you touch that middle, doesn't matter. Markets move to find liquidity. As soon as the market makers have isolated and found liquidity, market has found balance for the day. Is there an imbalance? Maybe. If you break out the balanced range, it's because one side closes their position more often than one side opens their position. So it's very hard for you to determine which human being is going to do that first with any other indicator. So on these streams, again, not financial advice, not investment advice, not a licensed professional, all the good stuff that you need to understand is that if I sit out, there's a reason for it. I'm saying I'm not doing anything, there's a reason for it. If there's a reason I say the market is kind of just clustered up, I'm not doing anything, there's a reason for that. I could sleep in my eyes. So when you talk to me after the stream and you go, well, we bounced around resilience a couple times. It kind of, you know, it looked positive and I thought I bought and it was going to move. And I tell you the same thing. Once you get here, take every indicator on a piece of paper that we have, that you have, that anybody sold you, that's in your super schmancy pantsy algorithm, crumple it up, throw it into the wastebasket, and move on to something else. Because as a trader, markets move in periods of illiquidity to try to find liquidity. When you pass through a balancing portion, mean reversion, liquidity pockets, all the same thing, markets are 100% random from here. The idea that it comes here and resilience is positive doesn't mean that it's likely going to move. This is exploiting all the mechanical features of S&P tracking the stocks. And while it is still strong, once you have found balance, our rules are very clearly stated. The market is random from there. You fall through here, it would dip and come back, it would raise and come back, and it did that all day yesterday, right? This. And so we had a positive doomsday, which implied that the market would likely want to travel the upper end of the band. We had positive resilience, which implied the market likely wanted to hold that as support, but it basically went nowhere. And it did a bunch of random stuff, and that's exactly what happens the minute you pass through here. Random is random. Rockscrew tells you that, and what nobody else has ever taught you in your trading career is a magical set of tools that are very repeatable that sit here and tell you when the market's going to actually do that. You can predict that it's going to do nothing or do nothing predictable, and from the minute the market opens, that's exactly what I did. Tapped it right here. There's that liquidity pocket yesterday. It was like 395.5. The minute you tapped it, it's over. Day is going to be all unpredictable. It could crash, it cannot crash. It's hard to say. So if you're trying to figure out how to trade something once it's balanced, then you already are doing the wrong thing. Morning, everybody. Tap that like button really quick. Give you about 5 minutes to do that. I'm going to take a quickie little break and try to get me something to eat. Look at my camera here. I'll be right back. You should check both of them, I would say, Goog and Google. Both can be important. right, let's check the we have the SPY checked here. Front and center. Good. Let's check out QQQ really quick. No, I didn't say today's random. I said yesterday was random. So what happens is market's random, right? And a lot of people said, was the data wrong? Hedge pressure looked very low. And so these kind of things I want y'all to understand. All of our rules are clearly stated, clearly documented. Everything's there. Ooh, not good for QQQ. Data looks okay. It's not abnormal to see what you're seeing. The positions are what the positions are. But no, not today's random. When you pass through a liquidity pocket, the middle between a bull and bear zone, it's going to be here. The minute you touch that middle, it is random from there. Okay, so with the monthly hedge pressure crash, this is also going to create an irrational type move. So keep an eyeball out of this. Whenever you are measuring hedge pressure break, it could potentially collapse out. So let's go here and look for any support. The trick is you're going to go here to the wall section, rocket scooter. You're going to go here and click monthly mode. QQQ and find where monthly support can be. 240 if it continues to fall on a monthly hedge pressure break. Be very careful today. If this is a sell-off day, 240 will be on the monthly side where that call wall support is for the rest of the month. Okay, I'm reading about the new update. We have a new release coming out. This is all about your experience when you onboard. There's going to be an email thing that's going to remind you about the Black Friday deals. We have a really awesome Black Friday special going on. If you guys want to check it out, head over onto our Discord and head on over to our website and get on the free trial. If you sign up before the end of your free trial and with the Black Friday special going, you can get half price on the membership for life. With all your data feeds, everything part of the package, Rocket Security, you can have it all. For half price, grandfathered in. If you're one of the cool kids or uncool kids, depending on how you perceive us. I think we're all right. Halfway cool. Cooler than a lot of things. Cooler than a hot summer day in Texas, that's for sure. Spies, just saying happy. Yeah. So monthly hedge pressure breaks, the first thing you want to do is try to find where any kind of supports can be. This is not good, right? So looking at this right here, we have to find out where any kind of potential low is. So look for call wall support down here. 240 is likely where that can be. Now, again, take a look. Bear short up. So we always go out and zoom out to the monthly side and look where that support is for next month. So if I'm a bull, 240 is now where that bullish support can be if it does collapse and crash out today. We'll see how that works. With the BRSU, I come down to liquidity map, and it looks like any break of monthly hedge pressure is an irrational move down to the next resistance. So we're going to try to find where they is. 240 is one of them. Let's head on over to here and double check what Doomsday is. We are inside of the band, so it's still rational and still normal, not unusual, but breaking through monthly hedge pressure can be a very bad sign. So let's double check what the Doomsday number says. On here, we got the numbers coming in still positive. That's a pretty decent sign. So as long as the market bounces off of something, we can pivot higher. And remember, the S&P does pull the NASDAQ with it, not the other way around. Does that mean we will continue up? What? Okay, let's just start over. If I use the word irrational and you're trying to rationalize what the market's doing, again, we have nowhere to go. Hedge pressure breaks, one of the 5 rules of being irrational. Again, market's going to be crazy and choppy and flat within minutes of the day. There is no understanding of where it's going. Dude, Settlers of Catan. Psh. I'm gonna own all the wheat. You gotta waste your time rationalizing. You have to determine quickly if the market's tradable or not. We have those 5 rules we check. I'll go through them again. If any of them flag, the market is unpredictable and strange and not going to do what you want it to do. So today, we're going to do the check very quick. First thing you do, inside the bands, check. We're good. Has VIX traveled more than this green line distance? If I take my little ruler and move it around, no, not even close. Check. Index catalyst, no. Check. Come back to the platform. UVXY. Are you in any kind of call wall zone boundary right here? No, you're not interacting with that. Check. That's 4. 5, hedge pressure breaks. That's it. The check takes literally 10 seconds and you're done. I look like Robert Downey Jr. Oh, stop. He looks like me. Come on, let's be honest. Oh, that's flattering though. So remember, since CD is above half and we didn't touch the top of the band, does that mean we will continue up if QQQ recovers back up? So be more specific in your question. If the market becomes rational again, I think my internet's being really slow right now. I saw this giant truck outside. One day last week, actually, or 2 weeks ago, I actually lost internet all for an entire day. It was crazy. So if the market becomes rational, then yes, all your indicators should now start to make more sense. Either it's technical indicators or whatever. The delay, the overshoots will be very possible when markets are irrational. Hedge pressure breaks show irrational amounts of selling. Be very careful about this. So breaking through monthly, not a good sign. Okay, this is showing abnormal selling today, and the market could fall very, 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 very far. Okay, let's go to the scanner. Let's look for things that are, actually, let's go to the SPY. So let's pull up some stocks really quick. Show you guys how the scanner looks. If you don't mind tapping that like button, everybody here today, let us know how much you like the free content. It'll be a very short stream. And then after that, I will see you guys in our Zoom call that we do every day for members only. Zoom call is a very strong lesson that we go over something different every day. The S&P, BSU, if we get the S&P pull up above hedge pressure and go, then that's a pretty decent sign. With resilience kind of hovering near zero, do remember when markets are irrational, resilience loses its leading edge, and so do most things. The market's now chasing whatever is going on around, and there is no rationality to be found. So we have to make sure that whenever you look at what you're seeing, is that the S&P, while looking okay, if there's a bull sign, it is here. But if resilience is less than zero, I may be cautious. However, because the Nasdaq broke through monthly hedge, again, every time you get the irrational flag, there's just 5 things. It's a 5-point check. Gamma squeezes on monthly hedge pressure breaks are very violent. 1 second. So when that happens, the market tends to destabilize a little bit, and your leading indicator, which is usually a very good leading indicator, is no longer a leading indicator. It can just track and come with delays. It can hug zero, and that's all stated in the rules. So as long as things are nice and stable and everything lines up. Now, the thing is we're in a bear market. A lot of people are asking me, like, you know, God, it's like you sit out most days. You're not doing a lot of day trades. And I go, well, in a bear market, that's kind of what happens. The best thing to do, I believe, as a trader in a bear market is don't really try to short everything you see. If you short at the top and get the fall, you're good. Or if you're buying puts and you get that really nice day that sells off, always day trade and get out. The idea with bear markets is that if you actually count the candles, it's an exercise we do. The daily candles on any run length of time in this entire year of bear market, we actually sat here on stream one day and counted them. They are literally one green day for every red day you see. So markets trade lower, but for every day down, there's a day up. It's crazy. So even in bear markets, looking for bull positioning is not a bad idea. And because in bull markets as well, you usually have 2 to 3 candles up for every 2 candles down. It's usually 60-40, between 50-50 and 60-40. Again, we counted decades of bull runs into that as well. So when you look at it, it basically just says there's always people buying, which is true. Always people buying. No matter what. Market goes up, market goes down. So I don't like to be in that I'm going to just short the market because it's a bear market. It's I'm going to wait and then I'm going to look for signs of a bull bounce and take it. Markets are irrational. I'm going to sit out. I got my money in my pocket for I get that bull play and I'll play it. Or if you are distinctively bearish, then I'll take the bear trade. There's no way against that. If we open below monthly hedge pressure, the market is bearish for that month. So imagine here, right? Imagine NASDAQ opens here. I would short against the monthly to bet that the bear market stays bearish, or that the bear hedging takes the bear market further. So I will take a bear trade when it makes sense, but even when markets are trading down, my brain is not, okay, let me short this. My brain is like, let me wait for a better opportunity tomorrow, whether it is short or long. And so it's not trying to trade every day. It's trading only when it matters. And I promise you this, in bear market, you hear the word irrational almost every single day. It's very hard to day trade bear markets. And if you want to know proof of why that is, ever since, and I'm going to give you guys some cool information. Ever since, if you ever go to like Twitter or something, right? Ever since COVID, right? The number of, I don't know, trade rooms went like this, right? Everybody had a trade room. And right now in the bear market, it's kind of back to here, you know, all your favorite, you know, speakers, teachers, trade rooms, whatever, they all disappeared over the last couple of years, right? Because in COVID, like everybody was a trader. Social media made everybody start a trading company or trading business or something. And effectively over time, people didn't understand, or they didn't know how to trade and they just stopped. They gave up, went back to work, whatever. So what you're noticing is that there's a reason people stay around. There's a reason people stick around for the long haul. And it's because they have some wisdom to impart. My wisdom, just for any of y'all, is that bear markets are hard to trade. They're easy to trade. You would see everyone trading them. Why do asset managers just sell all their stock when they get bad news and get out of the way and move to cash? Why are they not trying to day trade it up or down with your 401k? Because it's risky. Why is your 401k not shorting GameStop stock in a bear market? Because that's very risky and it's very expensive to short and hedge a short because you can't predict when markets are going to become illiquid and collapse, right? So there's a reason the tried and true method of stock market always goes up and your 401k is always investing in the long side of the market or going to cash when it's not long, is because that is really the only proven trading method that's actually ever worked for anybody, is to long when it's good and to sit out when it's not. If you have tools that tell you when to sit out, you can emulate that same style of trading. Market's nice and safe. Trust me in a bull market, right? Rational, stable, golden signals for like 40, 50 days in a row. It's like money trading. Bear markets are hard to trade, and that's what you got to learn, at least from me. If you're struggling as a trader and you're getting started now, or you got started at the end of the wave up, and now it's like you've been struggling all year, you're trading in a bear market, right? The pros of the world have no grasp on this market. The best trading algorithms in the world have no grasp on liquidity in this market. Throw your technical indicators out because they're completely garbage, and you trying too hard to trade is you remembering what your first year of trading was like when you get in and eating's good, right? There's a buffet on the table every day, and now you're here and markets are hard. And this is where you learn patience, and this is where you carve those skills. On a bear market, your job is to survive. Your job is to come out of the bear market with money in your pocket. That's it. It's to survive. This is hunker down, sit on your front porch, get your lawn chair out, your gas can, your chainsaw, and your shotgun. The zombies are here. You gotta wait it out until the apocalypse is over. Zombie apocalypse, right? Eventually they'll find the flu, the cure to the flu. All the zombies will go back to normal and life will be great again. In this environment, your job is to survive. If you get the irrational signal, you should tell yourself, thank God I'm not going to lose money today. I'm going to go out, have a great day. I'm going to go to Costco finally. You know, significant others bugging you to do this, do that. Go on to your chores. Take that day to understand I can predict the market's unpredictable. I will go away. And if you need something to teach you that, to beat it into your own head, you hit through a liquidity pocket. Do two things for me. Number one, guess where it's going to close. The minute you touch that, say, I'm going to pick out where it's going to close, and then disappear for the day and come back at the end of the day and see how wrong you were and scare yourself out of getting involved with that train wreck. Teach yourself that way. Just pretend to guess. I'm going to guess it's going to go here, and then it goes nowhere you think it's going to go. Number one, easy to do that. Number two is when the market's irrational, start paper trading just to practice. Practice how you would trade that market without putting real money on the table. Just again, to scare yourself out of trying to understand. that your indicators are going to do exactly what we tell you in the rules if you read them all. If you have an irrational move like a hedge pressure break, resilience will likely hug zero and be choppy and no longer be a leading indicator. That's very predictable that this will tell you that that is going to lose its edge. And it did, right? So they're all clearly stated. You have to not skip steps, especially here. We give a lot of rules that are very clean and easy to understand. The problem is bear markets, they're always going to be flagging. Bear markets suck. Bear markets are choppy. Bear markets are volatile. Very little activity in bear markets. Most people are buying sporadically and randomly, not because it's bullish, because they want to buy. So you're not going to get big waves up on the bull side, like very strong. You're going to get short, squeeze, short, squeeze. And the market's going to be very violent and react to catalysts. You have to just always be on point and ready to react. Everybody out there trying to long or short up or down eventually burn out. And I promise that is what happens to everyone. There's a reason that I don't get a lot of activity in bear markets. I like to just be patient. If you got to wait a year, wait a year. If you got to wait a month, wait a month. If you got to trade every day, you're going to lose all of the money in your account. That's just it. There are no successful day traders out there. Call on the long, call on the short, call on the long, call on the short. Such a system doesn't exist, or else people wouldn't be selling your 401k on bad news. They would have the perfect algorithm to long, short, long, short, long, short. If that system exists, T. Rowe Price would fucking have it, and they'd be doing it with your accounts. To stop buying into all these rinky-dink algorithms that are trying to call the market up, call the market down, call the market up. Because your 401k wouldn't be in that long side only or go to cash when I'm scared. Long side only, go to cash when I'm scared. The smartest traders in the world can't figure out that weirdo in their basement certainly didn't figure it out, right? So just understand that sitting out is the art form of folding. The best poker players in the world are not great at getting lucky with the cards they're dealt. They know when to bet and when not to bet. And when not to bet is how you make it to the end. That's the secret. Monthly map, let's do it. What did you say? Long look on SPY after hours yesterday at 400. Is that a phantom print? It typically is a dark pool print that's reported at the end of the day. So if it's at 400, what I always do when you see those prints, wherever they are, you see at 400. Did you see that long wick on SPY in the after hours yesterday at 400? A lot of times it's a late report. So when you report an over-the-counter transaction, like a dark pool, if you report it at the end of the day, wherever you report it, it just drops in the time and sales. So imagine time and sales is like the order flow, right? It just shows every order that comes through in a string of text, like a freeway of cars. So the minute that's reported, it just goes through the pipeline and hits the on-ramp and then hits the freeway of cars. So it just injects itself. So even though it's reported after hours, the order could have been previously at, any time in the previous day, and it just shows up. Your platform interprets it as an order there at that moment in time, which is why you get those spikes. But they're not prints at that price at that time. They're typically over-the-counter transactions, and a lot of time, if you match it up, 400 doesn't make a lot of sense right now because SPY's not. Actually, hold on. Let's go there. It could be. That candle a lot of times is a report against what I do is I look for where that print was and I try to match it up with an open or close. So a lot of times it's going to be some kind of over-the-counter balancing act. So a lot of times they will match the previous day's open or close. So that's one of the things to look at. Those closing prints, over-the-counter, market on open or close type fills, and they will just match that. But basically, it's to be ignored. It's something that already happened, and the reason it was reported late is because they were trying to hide that transaction in real time through whatever avenue they did, dark pool or other. So looking at open price with cheat sheet and looking at the Rockseer platform, some don't match. Is that common like Netflix? Okay, it's not supposed to match. Remember, teach you guys about how liquidity map works. You have to see it the right way. Most of you have been kind of poisoned to think that technical indicators and technical analysis predicts the market. Is impossible. Impossible. I have never seen an indicator-based technical analysis system ever worked. If I ask people for broker statements, they always balk and never provide them. They don't work. Predicting the market doesn't work. You can't do it. We can predict where volume will be very easily, and it does match. It's not, the arrows are not saying the market needs to go down. Probabilistically, greater than, if the arrow points down, then greater than half the time, we determined that it does that, but it could be 51%, 49%. In some instances, it could be 99% and 1%. What it's saying is that BSD for Netflix, for example, is saying that if you open below blue, so think of it like an if-then statement. If you open below blue and you touch blue, then I'm expecting sellers at blue. And if there are sellers at blue and it trades down, they're going to find the buyers at the open price again. So you think of it like this. If I wanted to short a BSD, then I will short it against blue and only blue. These letters change in real time based on where the price is. This is showing you where sellers will be and where buyers will be. And this is predictable and guaranteed. It doesn't mean that it will bounce there. It means that when you get there, if those buyers aren't there and you wanted to long from there, then you get out of the way. So in this example, it's a BSD now because it's on the short side of hedge. But when it opened up, it was actually a BLD. These numbers change in real time, and it did match. 100% did it match. You just have to understand that the numbers update in real time, which is nice. This right here is exactly what happened. Okay. And then if I wanted to buy there and take that scalp, which would I want to take a 3-point scalp on NASDAQ to go from here? The probabilities of breaking through hedge pressure, statistically, we did it with the S&P, is about a 4% chance you break out of hedge pressure. If you break through more than one strike distance, then the market is illiquid, irrational, and it's going to be hard to say. So if I did want to buy for a 3-point run and put whatever stop I put on here, it looks like 2.5 points would be my stop. It's about a 1-to-1 trade. I wouldn't want to scalp this. And we don't bet that it breaks from here. This is a warning that if it breaks to there, I don't want to be short. So those are breakout trades and gamma squeezes. So what you have today is a BLD that broke through hedge pressure. And so if I were trying to long Netflix today, the only long that really made sense is if it does the breakout and then I chase, right? So I would take Netflix long on that every day. As you've broken through and come down to the BSD, S means you're below hedge pressure. You switch modes to take a look at that. And now it looks very violent to the downside, doesn't it? So you have to watch it in real time. So technically it opened there and it matched exactly as you'd expect. You open below monthly hedge pressure. I always short against monthly hedge pressure to the next resistance. And again, I wouldn't have taken a 3-point scalp. Do they act as magnets? No, they are where order flow sparks. When you touch any one of these, if you have any of those unusual programs, right? Everybody says unusual flow, unusual this. Your unusual program, right? That's a big thing people are buying right now. It's very popular. They're actually pretty good. Unusual order flow, right? Has anybody type yes in chat if you've heard of anything with the word unusual in it, like, you know, bots or software or whatever that measure unusual flow? People say order flow, unusual flow. Let's tell you, right? So when you get to these levels, you should see those platforms start to give you your signals right there and right there. Like, ooh, there's unusual flow here. There's unusual flow here. But at the start of the day, we will predict where their signals will come from hours ahead of them, because the unusual flow and some of the highest volumes of the day come from touching hedge pressure. Because what this does, it's the peak burst of delta hedging, which means it's the highest order flow of market maker hedging. The lighter the day, the less of a catalyst, the more that all trading is just hedging. And so that order flow being there is that unusual activity. And when you touch hedge pressure, you now have a head start against all of those traders. As we will predict where the unusual flow will be, it doesn't mean that it will pivot the market, but it means that if I wanted to short, I short from there to there. And if I wanted to hold on to my short, close out a little bit, let it break and find the next resistance like it says. You still have to come up with an adequate thesis to long or short something. Now we have a couple of guidelines that I like to follow, is that if I'm below monthly hedge pressure on something, my brain immediately thinks to short against it. So I'm only bearish things when you open below it, and I would have shorted against that had I wanted to be bearish Netflix for the long haul. This yellow line lasts until the 16th of December. It's the third Friday of the month. So this will change day to day. And the morning we do the calculation, being below here, my brain immediately says, ooh, Netflix is bearish today. That's it. And all the unusual stuff, they're pretty good. I mean, they will show you where that flow will come through. But anytime you touch the hedge pressures, you will see there's random chaotic volume spikes, especially if you break through it. And you could pick anything that does that. Like, let's actually show you guys, let's go to the strategies and let's actually sort by hedge pressure breaks. Let's do break up and let's do break down. Let's show you what it looks like, right? Actually do one at a time. So anything that's broken to the upside, let's go ahead and show this, and let's show some of them that are greater than hedge. Let's look at something that's broken through hedge to the upside. So when you break through it, it's what it's to tell you is that on top of whatever system you use, this is risk management. So you guys are used to like going to some place and somebody says, here's a system, it's going to predict the market. You try for a year, it doesn't work, and you finally move on. It doesn't matter what system you use when you trade. Making money trading is being able to balance risk and bet correctly and sit out correctly. If I wanted to short Netflix, if it's BLD, and if I wanted to short, this is where the only burst of sellers I can expect to be minus random things I couldn't predict. So on the predictable side, you will see a lot of order flow when you tap hedge pressure. So if it's floating down here and I want to short, I'm not doing anything yet, and ooh, let me short from there. If it breaks through there, I'm going to get out of the way. So in a risk management sense, that's what this is for, to tell me when I'm wrong. Nobody can predict the stock market. So if it doesn't do what you want it to do, it's not, oh, the system isn't working. That is the random part of the market. I'm going to get out of the way. But if I want to short, this is where the biggest burst of sellers will be. And if they weren't there, they won't be anywhere else. So I'm going to get out of the way. That's exactly what this is about. The world's first risk management platform. So let's look at things that have broken hedge pressure to the upside and they're still greater than hedge pressure. Let's go to the scanner and sort by things that are right on the edge that are just now breaking. BABA, for example, okay? You want to look for stocks that are bursting through hedge pressure sometimes because that is the international sign for gamma squeeze. And anytime you touch these, it predicts the highest volume of the day. I'm not going to lie. This is what put us on the map and why you see that we're growing bigger and bigger every day. How the hell can these guys predict volume spikes that are even greater than the opening volume? That's what we do here. Hedge pressure. Hedge pressure. There's your unusual flow. Look at this. The current volume right here doubled at this exact level. And we tell you that. Right here, volume spike right here. The predicting volume profile before it happens is what we do. We're giving you tomorrow's volume profile today. So use volume profile on your charts. You're looking at yesterday's volume, guessing there's still activity there. This is using the mechanics of hedging to understand this is the max order flow of delta hedging of market makers that sold options to other market makers trading against you whenever you buy BABA stock or BABA options. So at the end of the day, this is the order flow to balance their risk. If I wanted this BABA trade, BLU, I would buy at hedge pressure. I would double down at monthly and I'd stop below. If I wanted to be bullish, why? Because I opened above monthly hedge pressure. This is called bull structure. This is called bear structure. You ever hear people say positive gamma? This number that's yellow is positive gamma for the month. That means if everybody took their hands off of the trading platforms for the rest of the month, and this stayed at 75 every day. Remember, these numbers do change to reanalyze every day. But if everybody took their hands off of trading and just robots started to trade, and this was at 75, and this stayed at 75 nowhere, and just algorithms balancing risk started trading, you would see this just do this over the course of the month until the expiration date. So there's just a generic natural push as you get more long order flow than shorts. That's what hedge pressure is. Why is my thing not drawing? Oh, guys frozen up. Does that make sense? So it's to tell me when I'm wrong in the trade. If I want to buy BABA, I'm going to take the attempt here. And as you see, that bull short up is that attempt right there. If I wanted to, remember, you still have to formulate a thesis as to why you're longing or shorting something. Why would I want to short BABA? Well, I'm betting that the market's bullish, like BABA's bullish, an example. So BSU and BLU, it's flipping between the two because it's hedge pressure. Let's put them both together. BLU has that bounce off of blue where there's a burst of buyers at that curve, and there is your burst of buyers at that curve right here relative to the neighboring volume. BSU, there is yellow to blue scalp, and again, yellow to blue scalp. And it's too short to want to take, but not everything's a clean signal. So what if I want to take these yellow to blue scalps that have a lot of room between them? Let's go ahead and look at that, right? Use the scanner. Let's look for something below hedge. Sure. And something above monthly, right? Below hedge, above monthly. Between the yellow and blue. And let's find something that has the highest hedge distance. I'm talking like there's a big run between them. Look at this, 30, 40, 50 points. Let's look for something that's reasonably tradable relative to its value. Sorry, hedge distance here. Nike, 14.5. Huge hedge distance, right? So I have a lot of friends in the black box stocks community and leaders there. They're all really, really solid traders and really good at what they do. Black box stocks plus our stuff together, people have called it the super system. You put the two together, they both compensate. They both work very well. I'm a big fan of what they made. I'm a big fan of Mel Stone. So unusual order flow mixed with hedge pressure. This is your risk management side of things. You get the hedge pressure. Their stuff is like ding, 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 unusual flow. You're like, okay, this is the pivot. This is the pivot that matters. Confluence between the two, perfectly great. And it breaks through it. The order comes through and you don't get the trade you want. Then you know you have a stop loss on the other side. So Nike is between the two hedge pressures. And now you can look at it and say, oh, there's a scalpable range. Now this is a really far distance. Let me find something that's relatively tradable, right? That's really low, but that's also good. That shows that Nike has still got bullish hedging for the month, and even at 90. So what we're seeing today with a lot of stocks is the market can fall really far and still be bullish. It's just the way it's balanced today. So let's look at some of the other, let's look at Walgreens, for instance, or something that's a little bit more, I guess, tradable where it can bounce between the two. Let's go down to the middle, like, let's go to 3M. You guys following so far? Click that like button for me really quick. If half gap, let me answer some of your questions really quick. So as you see, just being between them, you can find the ones that are tradable. Now let's actually be a little more specific, right? I want to search for this exact setup. I'm going to find some that are in between here and here and try to see if I can't get some of those pivot scalps, right? BLD. So let's go to the strategy and let's pick a liquidity map current right here. Let me find something that's just balanced between the two hedging points. Let's do BLD just like that. Let's remove the below hedge pressure because that's going to eliminate all of them from the list. And let's sort by ones that are on one side of hedge pressure. This is percent distance, or one side of monthly. So let's start at the monthly side where Oxy has a 75 point run between the two, and it's currently between the two, and it's right on the edge of monthly, right? So let's pull up a list. I can now filter by ones that are on the edge to take that scalp. So had I done this earlier, right, I would have found that, and actually let's find in a BLD, let's find ones that are below monthly hedge pressure as well, not the breakouts. So let's find just the scalpable ones. As you see, it would have that yellow to blue is there. It doesn't mean it has to happen. It just means that there are buyers here and sellers there. And again, there's your unusual flow as you tap hedge pressure, but we have the calculation at 9:30. These sit here all day. So you get a head start to pre-plan. And when you get the unusual flow coming through, then it confirms what you wanted to see. You'll follow that? So the best part is that you didn't have any risk management in your diet for anything you've ever used. You're just trading blind. Me, if I wanted to short Oxy because we're below monthly, is there a commercial in this video? Let's go back to start. Okay. If I wanted to short Oxy anytime inside of here, it's a BLD. The only place I'm expecting sellers to appear is either A, on a rush of breaking one strike distance on a hedge pressure break, which again is a gamma squeeze, or against monthly hedge from the bottom, as you see right here. As you touch it, there's your unusual volume spike that you knew an hour and a half ago, or 45 minutes ago. Are we all on the same page? Get a big old fat yes in chat if y'all understand now asking those questions. I love talking about this, and especially 6 flow. Does that make sense? Imagine that you used any system, whether it's technical analysis, fundamental analysis, whatever. You still have to be a trader to come up with your idea. these are probabilistic these are probabilistic moves that have to do with if there is no catalyst and if the market's rational, then I expect sellers to be here and buyers to be here, or buyers to be there and sellers to be there. So if I wanted to long a BLD and you wanted to short and it's in the middle, the best place to short, in my opinion, is against here where that burst of sellers will come. Because if I need people to short, I need that shorting volume spike to be on my side. So the trick is that this is how you do it. This is what nobody taught you. If you guys want to write something down, this is how you trade with volume pivots. Anything that can show you where volume can be or predict where volume can be is golden. So an example is, let's pretend that yesterday, and I don't know why my Epic Pen doesn't want to write. I should close it down and reopen it. Hang tight for a second. Oh, there we go. It's so slow, and I don't know what's going on. My CPU is just needing a little more juice. So imagine that markets just rallied like this, right? One day, and the whole day market just rallied a lot, and then you kind of jiggled around at the end of the day, and market closed. You come back the next day, there's a big catalyst to push the market up, and it consolidated there for 2 hours. And the next day, you'll have volume profile there. Right, volume profile there that will say, okay, this was Monday and now Tuesday. There's a high volume node here, tons of activity. High volume node here, tons of activity on that burst, on that catalyst. Okay, so market rallies, then comes back down to your high volume node on day number 2. Classically, you would say, ooh, I want to buy at the supports, but it's falling through. Ugh, let me get out of the way because it might fall to there. And classically, that's how you've all been trained, right? Big yes in chat. You'll use yesterday's volume to try to guess support and resistance. And if it doesn't support, you get out of the way, et cetera, et cetera. It's the same style of volume pivot that you're looking for volume to counter or assist the move you want. And if it doesn't happen, you get out of the way. In the risk management sense, this is good trading. It's just bad in information, because a volume profile is showing you there was volume here yesterday. If you and I were the only trader in existence, and I traded to you and you traded to me and I traded to you and you traded to me, and all day long we just handed one share back and forth to each other a bajillion times, then there's a huge order flow there, but there's no support. And that's a neutralization, right? There's only one outstanding share. It's me against you at the end of that day, but we create a lot of volume. What you really want to know is, are there open bears or bulls here still? So if the market rallies on a catalyst, sure, you had a high volume there. So a lot of bulls probably jumped in. A lot of shorts probably got out. There's that volume spike. So if you happen to go there and you want to expect there to be support, these people already bought. They're not buying anymore. So thinking there's support there because somebody already bought is kind of a failed concept. You need new buyers to step in as well. This can't imply there will be new buyers, and even worse, nothing can. You can't imply anybody will buy anywhere. And number 2, you can't imply that these guys are still long here. What if they longed and then closed everything out there on the day trade, and that was that volume? So not only is this trying to say there will be new buyers here, but also implying that because there's old buyers there will be new buyers here. And you don't know that they're still long, because when you get there, they could have closed everything out here and you could just fall through it like it's a rock. So the idea is that looking at yesterday's volume doesn't imply that the market's got bulls or bears anywhere. So what we did was correct that. And what you'll notice is that you get a lot of people say, the open interest of some options contract is like 10K. Okay, there's 10K open interest, but 50K volume, right? And they can say, ooh, that's a lot. That's a big deal. Well, not really, because there could be 50K volume on 10K open interest, and the next day that could have 2K. You can't take volume. It's just how many times things are traded. Options can be written and created. Options can be destroyed. Each one of those counts as one volume. So it's the amount of times trades happen. Doesn't mean that the OI is growing or shrinking. You can never determine that from volume. So a lot of people try. They say, oh, 50K volume and 10K, that's likely increasing the open interest. And that couldn't be further from the truth. And you can't ever do that. So what I'm saying is volume in the past is not going to tell you people still have open positions or they're changing their open positions. So what we do is we have 15 calculations now. Let's whichever way my hands are facing. 15 calculations that all predict volume. Predict where volume will be. Not look at yesterday's volume and predict the market will pivot. We're saying where volume will be. We have unique methods that can predict volume. This is the new wave of a paradigm of what trading is. So if you were using technicals or fundamentals or whatever, don't change a thing. But now you know where your volume will be, because if the volume is here, as I told you at 9:30, the volume will be here, and you cannot argue that that volume is not there 10 times what the current trading volume is. Tomorrow, there's your volume node tomorrow. There's your high volume node on tomorrow's volume profile, calculated today at the start of the day before the trading day even started. So the thing is if you touch hedge pressure, you are guaranteed to see an increase in order flow 100% of the time. You ever wanted somebody to boldly state they have something that works 100% of the time? I will predict where volume will be 100% of the time, every single time. Because this is balancing active delta hedging. All market makers delta hedge. It happens every time. Unless the computers are broken, it never doesn't happen. So anytime you pass through hedge pressure, you're going to see some balancing act. It doesn't mean it has to be bigger each time. There's still relativistic volume flow bump when you touch it. And of course, when you touch it there, this is not random. And even when you launch off of it, the volume increases as well. And when you tap the other side, there's volume there. If you didn't figure it out by now, hedge pressures are predicting a volume profile for tomorrow. And it's one of the most beautiful things. When we fixed this, or sorry, when we completed this and finished this algorithm, we all got so excited. Because imagine tomorrow, right? People are like trying to resist off of that tomorrow and support off of that tomorrow. In reality, that was today's trades. But they're using it tomorrow to try to expect that it's going to happen again the next day. Didn't this ever like light bulbs in anybody's head? So it doesn't predict the stock market. Nothing can. Nothing can. Technicals try to predict where price will pivot. Volume VWAPs and things try to predict where price will pivot. And it's not a terrible method. It's just delayed like every other indicator. How about predicting where price could pivot before it ever gets there? And that's the whole goal, is now we have indicators that will tell you where volume will be. People say, well, what time frame does this work on? You don't no longer need time frames. Any candle, the numbers are the same. It's hour chart, minute chart, daily chart, doesn't matter. The numbers are the same. They're like, so whatever you're doing, if you get your buy signal, right? Market is bouncing here and doing this, and you get your crossover averages signal, your MACD signal, whatever, your brain say, ooh, there's my long signal. Or RSI is like way down at 15. You go, ooh, okay, it's oversold. Let me go ahead and buy there. Then you step up on top of it, and then you take your regular system and you paste rocket scare on top of it, and you go, that's a hedge pressure break. Those can get very violent to the downside. And that's when you see like that 10 RSI go to 5 and 2 and just stay there all day and doesn't reverse. So you have a layer on top of technical analysis that corrects all its flaws. Not all of them, but corrects the delay part. There's no delay in this. This is looking forward. This is looking forward into the future. There's no delay. It's real time. So you have real time risk management analysis, so you can learn if you're wrong or right. Again, no one can predict the stock market. Just because probabilistically it does that and does that, imagine you're going to now use your brain to think about it. The market's very high volume and president tweets something crazy that nobody expected, or FOMC changes something. The market can go any way it wants and not care about hedging. That volume can step in and start killing everything off. If it's a nice algorithmic day, everybody's on vacation, there's no real humans here making a lot of crazy trading activity, and you expect the market to be just mostly algorithmic and systematic. And that's not drawing everything I'm drawing in my drawing tools acting kind of funny. But we're on the same page. It's all about risk management. So now let's say, all right, I want to do some plays anyways, right? Let me see if this rocket skier thing, I'm looking for something, right? And you guys want to say, the really strong correlation between price and a period of time and those dark pool prints. There is, and usually those dark pool prints are large firms getting in or out of position at the end of the trading day. and not wanting you to see it while market's trading, typically because options are expiring 15 minutes after equities market expires. This is again, if you guys are here, I'm going to teach you how all the institutions work and trade. What happens at the end of the day is that stock market closes at what time? 4 p.m. Eastern. And options market closes at 4:15. There's an interesting dynamic of a 15-minute time period that you may not want somebody to know, especially if you sold calls and you also wanted to buy the stock. You may not want people to know that you sold calls and bought the stock, right? Because selling calls and buying the stock is a premium collection method, selling covered calls, and you may not want people to know you were longing the stock. You may just want people to think you were naked selling the calls, meaning that you were not a bull, but you secretly wanted to be a bull, so you put an order at the end of the day in a dark pool. And then after the options market closes, then that print shows up 30, 45 minutes later, and then, oh, people go, shit, he did long the market, fuck, right? But then what happens is the options market is closed, and therefore nobody can respond to you until the next day. So that is why you see that in those dark pools. And those, you guys, does it make sense? So with the available options and tools out there, institutions will hide their hand so there can't be an adequate counter trade. Imagine if your boss goes, I need you to buy 1 million shares today and 5 million shares tomorrow. Okay? Because the market's falling, just get in today and then just throw the rest in tomorrow and we're done. Right? So you put an order at the end of the day to buy your 1 million shares. But all through the week, you're sneaking into that, selling those options, right? Just little bits at a time. Maybe the dark pool's getting you in. And you're building a big position, but under the radar. And then at the end of the day, you don't want people to counter those calls you sold because they, people can do the math and see the match of, oh, there's been order flow from this same thing, from this one price, and now somebody just bought these calls at the end of the day. Let me go ahead and, push the mark in those last 15 minutes after hours just to counter his trade. Well, if you do it after hours, they have to wait till the next day. And then the next day, the market opens and you just bought those 5 million at the same time everyone else is reacting to your first trade. So in that in between, you're going to see those dark pool prints, and they're going to come late and it's be a random spike in the SPY. And it's just people hiding their hands so that you don't see their entire trade until they're done. Does that make sense? So I ask people if y'all use unusual programs, unusual whales, black box, cheddar flow. Yeah, all of the unusual trading programs are very, very good. And actually, we have the same data that they have. We can build unusual order flow into Rocket Scooter as well. It's just not our business model. And I actually like to support other people and their original ideas and the things they come up with. Now, all those companies pretty much, no offense, they copy each other. I don't know who the originator is, but it's all the same exact order flow and the same exact data provider. So I don't think there's a lot of difference between technically. Again, I don't know enough to say anything, but reading that volume in real time and reading the tape also requires a little bit of human thought. And I know that Mel over at Black Box is like one of my favorite people that's really good at that. Simply Sim also a good tape reader. So some of the traders I know that I'm friends with in the space are really good at reading that. And so you need a good coach to learn how order flow should be interpreted. So there's some of the best out there. I think everybody loves you guys. Y'all know Mel, right? Mel's my homegirl. Super, like one of the smartest people I've ever chatted with as far as when it comes to reading the tape. But you also have to understand that knowing that flow should come there is also an art form. And so our goal was to try to show where that volume could be so that I can plan my trade ahead of time. And that's the art form, is that, oh, there's that ding, 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 there's that order flow. What do I do? Should I short? Should I long? Hold on, when they think about it, order, but at the end of the day, it's like, if I wanted there to be flow there and it gets there and I already wanted to short, I'm already in the trade. And then after it's like ding, 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 ding. Okay, there's the flow. And then I'm wanting there to be sellers to buyers there, right? So in the meantime, I want you guys to give me something that you want me to look at. I'll give you an example. And let's say that I wanted to look for stocks that are in between these two pivots, right? Which is what the first thing we did. Let's look for BLDs that are stuck between the two. We go to liquidity map, we pick BLD, we pick ones that are, don't look at SE, okay. So again, below monthly, above hedge. And I can now isolate just the leg I want in the trade. So if I do that like we did earlier and I pick hedge distance that's pretty large, I can now find ones that have big run potentials, like DocuSign has a $3.75 run. It's kind of in between the two. It's not against the pivot. But just to show you the example, You can now filter and sort by the exact trade plan you want where you expect volume to be. Again, you hit hedge pressure, there's your volume spike. I'm about to prove that to you guys. And so is the first the first retail platform that has volume prediction. It's great. Now it's, again, people that say I predict the stock market, I always want to punch them in the face. Impossible to do. But you can predict volume flow because delta hedging is consistent and it never changes. And the great part about it is people say, well, what happens if they figure out, Matt, that you're reading what they're doing? Market makers are operating at peak of algorithmic efficiency. They are delta hedging. There is no other method to hedge options other than hedging with Greeks. For anybody to change what they do, no matter how good we are at watching them, we would have to reinvent a new way to price options that's not Black-Scholes. Talk about a more accurate trading method that everybody will then adopt. And then we'll just figure out what they did and exploit that. It's one of those neat things that there is no counter to what we've built. People say, if everybody knows where pivots will be, what if they change what they do? Who's they and what would they change? Oh, well, this kid and the rock suiter guys, they all figured out that there's order flow there. So let's all not efficiently delta hedge. Let's inefficiently delta hedge just to trick them. Let's lose money on purpose. Retail is going to be so small, even with 10,000, 100,000 people knowing where those pivots are. It's dropping the bucket. So delta hedging is delta hedging. There's your volume spike. It will always be there because they never will change. They can't. And that's the neat thing about understanding that. So technical analysis, even on as weak as it is by itself, still is never going to change, right? Ooh, everybody buys at a 50 fib. What if they counter that and sell it at 50 fib? No, nobody cares. Nobody looks at stuff like that. So let me find some that are in between the two that have a nice little pivot. And I'm going to sort by ones that are right on the edge. Kroger is right on the edge with the 50 point, 1 second. I'm going to actually take a picture of this. I'm going to make sure I can see some of these. So an example, Kroger should be in between the two. And now I can say, okay, there's a BLD and I'm expecting volume here. So you basically take it like this. If I want to long Kroger, I'm not buying that dip or buying that dip or buying that dip, or I might just buy where I want volume to be, right? And if I get to here, half gap is also a high volume pivot, as you see right here, predictable volume. And each of these lines will be predictable volume. So the idea becomes, if I want to long, then I long from here to somewhere. I need volume to come at that level, spike, and when that volume starts to decay, whatever side of the pivot I'm on while volume is decaying is typically the winning side. So the way that it works is if I hit here and there's a volume spike and it's playing around here and that volume is starting to decay out and that hedging has found its balance, as the volume decays out, if we're on this side, then the new wave of hedging pushes it that way. If the volume decays out on the initial wave and we're on that side, then it decays that way. That's how I perceive it. I'm writing a note to my team really quick. So I think I'm going to change this hedge distance correlation. I'm not sure. Here's the thing. I want to know, like, and when you do percents, right, the percent is on a basis. So I was looking at this and I was trying to remember how I programmed this. So an example, Kroger, right? Here's your hedge pressure. There's your spike, right? We keep talking about that. We'll do a couple of tickers you guys want to see. But what I brought on this example is I'm just going to double check this, right? So hedge distance is the distance between the two in a percent basis. Now, if I change this to dollar distance, right? They should all equal up. Like this should add to that, this should add to that, etc., which is good. So when you do percent basis, the reference point should be different. So a percent move, if that's the reference point, is from high to low, is a smaller percent than that distance from there to there. I want to make sure that we reference it the same way. Now, I think I want the percent just to double check. Is that in a, let's just do like a little picture here. I'm going to draw it on the screen. Okay, let's run some of you guys' stickers. Make sure you go to rocketscooter.com, check out the platform, get that free trial, and make sure if you guys like this, you want to add a specific, you want to add new tools to your tool bag. $100 a month will get you 15 indicators that nobody in the world could ever have that will show you where volume will be. $100 a month, that's it. It's half price for life. It'll be $200 once we hit our 1,000th member. It'll be $300 once we get crypto, Forex, and futures in the platform, $300 a month. If you guys are in Rocket Scooter, you can have everything we ever make for $100 a month with your data feeds all provided. Plus the education, all the other cool stuff that comes with the traditional trade room, we give it for free. So you can hang out, use our platform, get our data feeds, check it out. Yeah, let's check that for Irrational still. One of the things I want to say is that, you know, the hedge distance, I want to make sure that when we do this is that if it's down, the percent distance, if it's, for instance, 50 cents, right? 50 cent move on a percent basis, I need to make sure he's not making that percent basis off the current price, whereas that number's changing. That I think the 50% move should be, so should we have hedge distance down or hedge distance up on a percent run? And that's what I'm thinking that we should do. Because 50 cents from 48.50 is a different percent than 50 cents from 48. And we just do hedge distance, and what the way that should be programmed is that it's the distance from HP, it's MHP minus hedge pressure. It's the distance and it's absolute. That's why it says absolute. So whether up or down, it's the same number, but what do we divide it by? And so in a down case, it's pushing from there to there. In an up case, it's pushing from there to there. So the reference point is always MHP, which makes sense. However, if you are at HP and wanting to trade up, and it says you can get a 50% run, you can actually get more because this is a lower reference point. Dividing by a lower number, the denominator makes the whole thing bigger. So I think we should do hedge distance up, hedge distance down. Have hedge dist up and hedge. Y'all agree? Meaning that up divides by the lower of HP, MHP down divides by the higher. That way you can, because the percent is more like for options traders. Ooh, I could get a 50% move on the upside. It should be one for each, I think. What do y'all think? See, invented something on the fly. Agree? Just to have, so that you can actually further understand. It's about how much you would make if you got that run, like 1% of you would make a 1% move. That's the whole point that you can see. Okay. All right, let's go. Some things you guys want to look at. Let's check if S&P is still rational. Let's go. Hold on, I think I gotta... SPY's monthly hedge pressure. Let's do a monthly map really quick on SPY and QQQ just to double check. SPY is breaking through hedge pressure to the upside. Very, very, very cool. Doomsday is greater than half. That's nice. Resilience is greater than 0. We are actually irrational to the upside, but irrational to the upside tends to smooth things out nicely as opposed to irrational on the downside, which makes things go chaotic. So let's double check. SPY is now bull long up. If I went to long SPY, there's that volume spike. You cannot argue with the volume spike at hedge pressure. Again, $100 a month gets you predictive volume. Add to whatever system you use. You will have a pretty okay time knowing where volume should be. Okay. So SPY is breaking through hedge. Keep an eye on that. Upside breaks could be very strong. Volatility and decay today. NASDAQ is again hitting hedge pressure. You have most of your volume have and the effect at the break, right? You hit it again. Again, there's your big volume spike against it right there. So it's looking pretty interesting to see. Let's go ahead and put NASDAQ resilience on here just to get a little bit of extra. Understanding. So that NASDAQ resilience is still less than 0. So both of these being less than 0 is showing that that and that are supposed to be resistance. And you're actually seeing that right now. So yellow being below 0, yellow is resistance, right? White being below 0, white is resistance. Resilience is such a cool indicator. But the S&P tugs the NASDAQ along. So if the S&P is positive, it's more likely the S&P will pull the NASDAQ up than the NASDAQ will pull the S&P down. That's just how the S&P works. There are more stocks in the S&P. It's more diversified. It's more representative of people moving money out of the stock market in general and not just out of a sector or two. Right here, market's trading down. BRSD and UVXY, nice and rational. Market's good. Let's take a look at the doomsday bands and take a look. There's that upper doomsday band. There's that doomsday trade on the S&P. Now again, market might have been irrational at some point. Because of hedge pressure break on NASDAQ. But the S&P stayed rational. So you do have a choice to make, right? You see NASDAQ is irrational and starting to sell. Maybe I should be cautious on my S&P. While Doomsday does say we should tap the upper band, that's pretty much it right there. What Was it a good trade? Maybe, maybe not. But again, the travel distance wasn't too far from here to here. If you took that risk, you knew that the risk was Nasdaq could fall to touch the lower band, or even go worse, you had a monthly hedge pressure break. And if you chose to sat out because it's irrational, you missed out on practically nothing. Now, while the S&P has that desire to touch the band, which our indicators do say it should do, it may not have been actionable because it was irrational. Somebody's question today, if the doomsday band is greater than half, should it touch the upper band? And it says more often than not, it does. But was it tradable? Well, not necessarily, right? You might have missed out on a 10-point run. Even though it did it, as we expect it to, it might not have been tradable. And that's okay, right? Not everything was tradable. Spiner map is BSU. Yeah. Wirenet's been very slow, so let me double check. It will change in real time, right? That monthly hedge pressure is just extremely low, and we keep checking that. So let me double check this really quick. This is... It is 370. Took the ninth. 360. Second. 394. That's crazy. This is crazy. Seeing all of those monthly hedge pressures all over the place. The market is looking really bullish right now on these monthly maps. Is that a DD band short off the top band? I don't short against anything but monthly hedge pressure. That's my main rule of trading. I only short in a bear market to bet the market bears. I'd exit along the upper band. I wouldn't take a short there. Could the short play out from there? Yeah, it could be a glorious short. Yeah. With volatility and decay, I don't expect the market to be volatile. So I don't expect the sell-off to sell off hard. Still, VIX gives me a sign that's going to happen. Or more of a long target. No, in the band, a rational market doesn't break irrational randomly. That's the whole point. This is some heavy EDM music. Let me start over where it's kind of a little calmer. So I don't bet that it breaks and becomes irrational, right? So this is looking great on a squeezy sense. I like what I'm seeing. So now with S&P being on a BLU, let's find an upper target on BLU. Let's go back to the walls function. Let's do monthly mode and look for upper targets, predicting price targets. Let me see that the S&P above 396 has no resistance on monthly. That's good. Let's go back to a bigger chart. Well, I just don't think it's swim. Do we have any gap fills in the S&P? Let's double check. Let's go daily chart. Let's put SPY front and center. So this is from a video called Predicting Price Targets. If you've never seen it, this is one of my favorites. Let me get all the video really quick. Go watch this video today. It's got all four of these methods I'm about to show you. Make sure you go to the Discord. I'll give you the link very quick. In that Discord, we'll be there a little bit later. We usually have sessions every day. I do have a really busy day today, so I'll have to be a little later. But I'm also editing all the sessions we've done. I've got like 15 videos I really need to get out. All these little training videos we made right there. It will change in real time because when price moves above hedge pressure, it's long, and below hedge pressure, it's short. Those maps will update in real time, I promise. You have to be dynamic. Where are all my gap fills? Ah, here they are. Okay. So my gap fills here. I've got a 406.49. If there's a breakout, actually there's one gap fill there as well. Let's mark it. Where's that dashed? Dash that. So already the S&P has a gap fill here. So one of the things I look for is gap fills on any upside break. So S&P does have a sell imbalance here that has not been filled. So any burst up would like to connect with the sell imbalance, right? So that's number one, is that the upper target on a breakout is to there at minimum, right? That's where you're going to find that next burst of volume. Then we do something called yellow line and red line, which we'll do on the futures. So no monthly walls resistance. We have a gap fill very soon. And let's look at the futures really quick. So there's 4 different targets today, predicting price targets. One of my favorite techniques to teach. There are videos on the YouTube. We have a bunch of 5 and 10 minute videos on YouTube. Again, everybody here, if you're asking me how I trade, I always find every excuse to be a bull. You will rarely see me short markets ever. The markets are selling off. I'll sit out and wait until it looks better. Is upper doomsday band a place to short? It is, but I'm going to tell you, I don't do it. If you're here to learn from me, I don't do it. I don't short unless markets are bearish. Bear markets have very clear signs below monthly hedge pressure. The only reason I short. Let's see if you guys understand that. You'll ask me the same questions a lot, right? First of all, watch this video for predicting price targets. Number 2, when do I short? When does Matt short? Type it. Is upper doomsday band a short target? Your question from your team should be, is that in the rules anywhere? When bear structure is there, bear structure, I will short bear structure every single time. Let's put my glasses on, so I want to read this. When I do that face, people say I look like Paul Giamatti, the actor. Handsome fella. My study face, he has that kind of... He's a great actor, one of my favorite actors out there. All right. So here we go. Each one of these categories predicts volume, predicts volume, predicts volume. All these indicators predict volume. There's 15 of them. They're all different. Rules of thumb. Don't use any pivot equation or enter new trades in the last 2 hours of the day, 2 to 4 Eastern. When volume's ramping up when humans are playing the game, don't worry about what they're doing. You're not going to figure it out. I only short the market if we open below MHP in the S&P, and only short when the index taps MHP from the bottom to confirm bear structure. I only short the index itself. I don't even short stocks. Very rarely will I short a stock. I will find bull stocks, or I will sit out, or I will short the index. Shorting the index is a lot more robust than shorting a stock. Candle count rule. Bull markets rationally are 60-40 green red. Bear 50-50 means at least, no matter how bad the market is, you're going to find half of the days are green, which means I only short if it's red and it's going to crash down. I know it's going to do that. I don't swing trade a short. Oh, let me skip a link. I don't say crash just because market is selling. Crash by my definition is when candle count is broken to the downside. So the 50-50 rule, which means in a 5-day period, you need at least consecutive days of lower lows, which means you are now having multiple days. And crash is a very short-lived. A crash typically is like 3, 4, maybe a week of selling, and then it recovers. COVID started selling, and then it crashed for a week or so, and then it turned around and came back, right? A month of selling wasn't a month of crashing. It was like a small crash recovery, big crash recovery. The stock market collapse in 2008 was like a bear market that ultimately crashed, and then within 2 months it had bottomed out and rallied and never looked back. The crash is the selling of lower lows when candle count is broken. Actually, I need to make sure I say that. Oh, I do. Three lower lows. I never swing a short because of candle count for more than a day. Every other day is green unless markets are crashing. So if I get my big short payout, I cash out the end of the day every single time, because every other day will be green, which will nuke. Short trades capture premium due to A, delta going in the money, and B, IV. You get that big spike in profit and you were short and that market collapsed. It's the silliest thing to say, it's going to continue to crash and crash. Let me just hold on to my swing. A short play is like, I will buy months or 2 out if I want to short, or a month out if I want to short, because I think it's going to be a bounce against hedge pressure monthly. And then it kind of rallies up, and I get that big sell-off day. I'm cashing out every time I get the run. I never swing a short. Do we understand that? Because if you count the candles and every other day is green, then you will lose that IV burst that you got, which gave you that profit. And the next day, if you sell off and the next day retraces a little bit, your IV is completely collapsed and you can say goodbye to all that value. You want to sell your puts that you bought at the peak of the frenzy, which is going to be at the end of that day, mostly. If the market gaps down the next day and starts to trade up, your IV is going to collapse and lose your profit. I never swing a short. I get in, I get out. I swing longs all the time because volatility is in decay and I'm not losing much premium due to IV collapse. I only short the indices and rarely short individual stocks. Instead, I will sit out with cash in hand, ready to long bull breakouts or squeezes. Bear market rallies or upside squeezes are some of the best gains one can get, and that is true. You want 1,000% gains. I mean, bear market rallies are just rapid squeezes that are great. Volatile bull breakouts. Love them. Okay. If VIX is greater than triple B, I don't like the long call or put option since markets usually choppy and premium decay is much easier. This period is a month-long calculation. We are below triple B, so these don't apply. If above triple B, which means, you know, we underpriced volatility a month before, I only day trade and never swing because it's too volatile. Again, up in that area, I'm only day trading. So triple B is on the chart here. And we are in this December triple B, which I've marked. We are below here, so swing trading is on the table. Okay. So if you're above that line, it's just I'm getting in, getting out, getting out. Market's too volatile to trade for swinging. You're going to lose a lot of premium. Discord bots give risk interval and yellow line distances. Committed trader shows positional risk in futures. Anytime there's identifiable catalyst on the calendar, I have no position going into it. That's just smart. I never flip flop, reverse my position in a trade. If I'm long or short and I'm wrong, I get out and stay out and find something else. No over trading. Mean reversion means the market is already near liquidity. If price touches either wall and hits the middle, then it's random from there. I move on to something else, which is what everybody's asking me yesterday. Well, Resilience said this and that said that. Within 5 minutes, you hit the liquidity pocket and I move on to something else, including the index. SPY will always pull a QQQ and not the other way around. SPY is a more diversified basket and therefore more accurately represents the money flowing into and out of stocks as a whole, and not just leaving telecom, healthcare, and tech. People sell Apple stock and start buying ExxonMobil, the SPY will hold flat and QQQ will come down. Who's going to win that fight? Well, nobody's selling stocks. They're just moving market cap from one stock to the next. As a matter of fact, the idea that money is leaving the index is why markets will likely sell. As people are moving to cash, there's less liquidity in the market. So if QQQ goes down and SPY is flat, SPY will likely pull QQQ with it. If QQQ goes up and SPY goes down, SPY will also likely start to trade up. If the tech or healthcare was gaining market cap and the SPY didn't move yet, it means people were probably selling JP Morgan and going into Apple stock. So sector transfer from S&P to NASDAQ, flat S&P, positive NASDAQ, again, is not a sign of selling that the NASDAQ has to sell off. Again, more likely, the site that nobody's selling stock and going to cash would likely pull the market higher. If SPY points up and QQQ points down, 9 out of 10 times SPY wins that fight. Again, SPY is all sectors, and you need to understand money flowing into and out of stocks in general is really why markets and indices pull back. So you need a very diverse index to be your most appropriate view of the stock market. SPY wins the fight every time. We good? Overnight trading, dynamic hedge structures, I'll be at that, this and that, this and that. More rules of thumb. And again, that's it. The rules of thumb are pretty easy because there's not that many of them, right? It's like I don't short, I don't flip flop. I only short when it's against MHP. Sometimes I swing, sometimes I day trade. And that's basically it. I don't flip flop or ever trade. When the market's random, I sit out. Somebody said yesterday, well, I don't know if I want to learn 15 or 20 different rules that tell me when to sit out. There's only 5 that say irrational, and there's one that says random. So when it's random, you don't have to sit out, but you have to assume that it's random, and you're not going to be able to predict very easily. You can still go gamble and flip a coin if you want. There's really only 6 rules, 5 irrational, 1 is random. So they both basically mean the same thing. It's hard to predict what's going on. It's just that mean reversion or liquidity pocket is rational and random. The market just found balance, and you can't expect a balanced market to spontaneously explode into being imbalanced again. It does not make any sense. So if you don't want to learn 5 rules that tell you to sit out, then you're not doing the appropriate thing when you're counting all the cards you see on the table and calculating the odds of you getting that queen you want on the flop, and you're not appropriately betting with the available tools with you. If there's something that tells me to sit out, it's a 100% chance I need to fold. If I get a hard 13 on blackjack, I need to fold my trade. 5 rules that let you count cards while you trade. That's exactly what we do, and that's why we did it this way. Entry rules are just kind of like different rules of thumb on how I like to trade. Stop rules are all the irrational stop rules tell me when to get out, and they're very, very, very descriptive, but very much never broken. Half of it has to do with circuit breakers that can ruin your life. Make sure you read those. But irrational and general stop rules, any of these 11 things tell me to get out. Again, these are probabilistic things. They're not hard to check. These take about 5 seconds or 10 seconds to check. We do it every day. And then non-irrational stop rules, like I don't lay in the trade in the last 2 hours of the day. If you move from bull zone to bear zone or vice versa, I don't stay in that position and bag hold. VIX breaks buffer in the same direction. No hedge pressure break. That's another topic. But again, the volatility can cue me out. We touch liquidity pockets 100% random from here. Once it's found, it's in the predictable period. It's now balanced. And again, this is mentioned 2 different places, right? Bounce off yellow line or red line. I exit the day when I'm winning and stop if I'm losing. And then I have like a pull the ripcord at the final, like during the headlight moment. I just have a max loss that I pull out on. So my rules are pretty solid and repeatable, and I never break them. Never. You don't always fold a hard. Yeah, that's true though. And I'm not a great blackjack player, by the way. But yeah, sometimes you don't. If the dealer is holding, like I would say like a 5 or a 4, you assume they got a 14, right? Or if they have a 2, you may have a 13 or a 12. So 5 or a 4 and you have a hard 13, you might want to hit. Yeah. They may have 15. Roadmap to probabilistic success. There's never guarantees. The guy wanted you to push the button for him. Definitely don't show holidays, yeah. There. All right, let's go. Yeah, so you guys have any questions? My glasses on so I can read all that. I don't like the brightness of reflecting in my glasses. Take a look at IWM really quick. And let me just, some of the tickers you guys want to look at. Yeah, we'll run some more. SE, BA. Okay, let's go. Sorry. SC bull long up. As you see, there's that volume spike at hedge pressure. Right, monthly hedge pressure, there's that volume spike as you broke through hedge pressure the first time. So there's volume here, there's volume there. Again, volume spike, volume spike, volume spike. So SC is a bull long up, it's breaking out. It actually lost monthly hedge pressure and recovered. That's a really good sign. So had I wanted to long this, right, on a BLU, I would have longed and then stopped out, and then I would have attempted another long as it broke through a second time. You don't tend to break hedge pressure twice in a row. If you do open bullish and you do break and it comes back, that's a good bull sign, and I always take that trade. So sometimes the market becomes unusually volatile or irrational or something happens, but once things snap back into place, again, I'll take a trade a second time. As long as things look good. Your bull long up, BA, same thing. Bull long up, Boeing from here to that put wall resistance is typically that trade I like to take. You know, you have a bull long up goes to the next resistance. There is a clear resistance there on put wall. That was easy to see. That trade's over with though, but you've seen that this morning. Micron. Bear long up that squeezed. Okay. Talk about illiquidity pockets really quickly. When you have the difference here, when the call zone or the bull zone is below the bear zone, it's different than a liquidity pocket. It's the opposite. It's called illiquidity pocket. In a liquidity pocket, the bears are below the bulls. That's your normal structure, just like over here. Bulls on this side, bears on that side. Bears are lower than bulls. That's a normal balanced market. This is different. In the middle, bulls are in the money and bears are in the money. The market does not like to be in the middle. When they're flip-flopped the other way around, it likes to jolt from one side to the other and pick a side. So we call them illiquidity pockets. There is very much no balance point here, because in the other way around, one of the neat things that you'll notice is that, let me get my little drawing tool here. Come on, buddy. Come on. Whatever. I'll just use like this Microsoft Paint thing I'm doing. You guys liking the morning streams? Feel free to, let me just clean all this up. Erase all link. Okay. So when you have bull zone and bear zone, is that in the middle liquidity pocket, the other way around, and bulls on top of bear, just like that. This one right here that I'm circling, liquidity pocket. Bulls are upside down, bears are upside down in the middle. You shorted here, you're losing. Well, it's in the middle. You long there, you're losing. Liquidity pocket, call it the losing pocket, LP. Every trader is losing in the balanced market. Bulls and bears in close proximity, the market's very liquid. That's what liquidity pocket means. Everyone's losing. Illiquidity pocket is like a not mnemonic device. Everyone's in the money. Everybody's in a good trade. However you want to remember it. The other way around, the bear market and the bull market flip-flopped. So in this portion, the market's very illiquid. So in the middle, so remember, BR or bear's side or bear zone, or where bears are where there were no bulls. It's bear while it's illiquid outside of the pocket. So imagine everybody shorted on a bad catalyst. Market makers had to buy from the selling, and then they bought puts to offset their long. So everybody's shorting down here. Market's illiquid because there were no buyers, and dealers have those puts. It's illiquid outside of the pocket. So normal liquidity pocket, liquid in the middle, illiquid outside. But illiquidity pocket, it's illiquid in the middle. And it's liquid on the other side around. The idea is that in the middle, bulls are winning their trade against the market makers, and so are bears. Everybody's winning, the house is losing to everyone. Ugh, they don't like that. So they're going to force one side out of the trade by cramming it into the other side. Right? So in a liquidity pocket, if people start buying, then dealers are just going to run to the bear side and smash them together. People start selling, they're going to smash it to the bull side and match bulls and bears to get out of the way. One side's got to lose to the other. So an illiquidity pocket, they're going to hold it in the middle because everybody's losing. And no matter if you are a bearish and you cover, price goes to there, you're buying. If you're a bull, you're likely selling. And so it kind of, when you're upside down, you exit your trade, stays in the middle. If you're in the middle here, you're both winning, and people are going to take profits rapidly while the market's illiquid, which means it's going to move rapidly. So illiquidity pockets, the market bursts from one side to the other. It's the opposite of liquidity. So it's a neat understanding of the principles of liquidity. So as you see, once you're inside the range, it does not want to stay there. There's no revert back to middle. There is no balance here in the middle. The market's like, oh shit, there's bulls. Boom, cram them in the bears. Do we all see that? It's a whole different setup. Love the stream, Matt. Appreciate it. Thank you, Sean. Appreciate you. You definitely don't short holidays. Yeah, I don't. If you say you're looking at a play that is a BLD, the price is currently between half gap MHP and res, and monthly res are positive, for example. Okay. He's saying you're looking at something like this. It's in between the two. Oh, between half gap and MHP. So you're actually on this side of monthly. And res and monthly res are both positive, which means you're going to be on that side of monthly likely, and then res will go positive, so you'll likely fill the gap to the upside. When you look at the walls, there's a put wall at $2 above MHP. What stock are you talking about? When I expect price to break into the put wall on a BLD. So if you were above monthly hedge pressure and you're supporting hedge pressure, the trade goes to the open price if you gapped above it. That is the trade I look for. If it continues to go, that put wall is my next resistance, yes. If monthly res is positive, as you said, I don't expect monthly hedge pressure to break as easily as it to hold. So yes, I'd expect that play to work. And this is hypothetical. I'm just reading what you wrote. If resilience is positive, then the market's likely to go higher, especially if you gapped up, then market is more likely to go up and fill the gap to the upside as well. Right, so all of your setups, I agree. I would buy, for what you're describing in an arbitrary trade with no ticker, you told me, if you gapped up and res is positive, then it's likely to hold half gap and go. If you gapped up and market's opening above monthly hedge pressure and it falls to hedge, monthly hedge, and that yellow resilience is positive, then I expect it to also bounce and also support the gap up as a gap and go. Yes. If there's a put wall, well, if you trade from here and then you find those sellers at that gap up, if you support open and then it goes higher, then that put wall is your resistance. But you have to break through the open price and a gap up. 100%. So you have to remember, if you gap up and fall to monthly, the trade goes back to that. If you support the open on a gap up and continue to go outside of that redistribution zone, then that's a great trade to that put wall, yes. Cool. Is it possible for market makers to hedge their stock exposure to, say, Tesla and SPY? So I buy puts or Tesla and MM, sell you that put the hedge and SPY. Yeah, all the time. You can. It just depends on that company's strategy. If the market makers are market making 40 different stocks, they may go out there and hedge the SPY by longing all the other things or whatever. I mean, certainly, right? It just depends on everyone's individual strategy. Now, I wouldn't necessarily assume that strategy happens all the time. In this environment, it is happening all the time. This is a high correlation between equities prices and index prices. So normally you'll see the index go up and stocks be all over the place in a normal bull market. But this environment, as trading's become more algorithmic, I think Bar Chart posted this correlation that says this is the highest correlatability between the index and its member stocks, meaning that if the index goes up, there's a higher percentage of stocks that also went up today than there has ever been in the history of the stock market, meaning that the index is calling all the shots, meaning that people are either buying all the stocks at once or selling all the stocks at once and not being too picky. It's really hard to pick a winner in this bear market, but the index goes up, pretty much every stock is going up with it. And you haven't really seen it this correlatable in history. It's just one of those things that when you're digging out of a recession, and in 2022, it's different than the recession in 2010. You have more sophisticated algorithmic trading, faster market making, all kinds of stuff, better information. So people are just getting in all the stocks and getting out of all the stocks together more than anything. So longing a Tesla or longing a Microsoft and then hedging with the SPY is more appropriate in this environment than it's ever been, but it may not be the best choice. A percent move. If Tesla drops 10%, your SPY may only drop 0.25%, right? You're not going to have a very effective hedge than if you bought Tesla puts instead. So you not likely see market makers hedge individual stock with an index product unless they're market making a lot of stocks at once. You would buy the index if you had a lot of things and the index represents a lot of things. You might as well just buy the puts in that one stock. That one stock may have a catalyst that the index won't see. So your hedge wouldn't work. It's a less effective hedge in my opinion. If I'm buying Tesla and Tesla has a hedge pressure here and I want to buy puts, well, if I buy SPY puts and Tesla collapses, SPY will come down a little bit. So it'll cost me more money to hedge that Tesla with SPY because the SPY won't get the same percent move. So I would much rather hedge with the individual stock options than anything. Okay, I'm gonna call it a day. I'm gonna head over to the Discord. If you guys haven't been to the Discord, go there right now. I'll give you the link. Check it out. We will be there in a little bit, chatting it up. So we usually hang out when I'm after the stream. I like what I see on the market. Things are looking super good, nice and steady. This bull push today is actually really nice. NVIDIA got a nice run up in the last hour. I'm liking NVIDIA today. I'm gonna teach you guys how to do some plays. If y'all come today's session, we'll do some scanner plays. And again, we don't teach everything on the YouTube. We just kind of demonstrate. Walmart's looking super tasty today. TXN's looking super tasty today. All the chips are looking hot. I'm liking what I see. I'm really liking what I see in this market. Scott Life, baby. Let's go. Head over to that Discord. Get in that free trial. Make sure you get Rocket Scooter. Check it out. We had 57 people sign up this week for the free trial. Go in there. See what you're missing. Check it out. Learn what those volume pivots are and add risk management to your diet. No matter what you do or where you go, if you know where those volume pivots are, you got a great place to start in understanding where you want to put your stop losses when you trade. It's one thing that's always been missing, and we made it. And hopefully you guys have a little bit of a better understanding of why markets move and how they move against you and how to manage your trades before you get into them. That's what we do here. We love it. We love seeing you guys and going to that Discord. And today we'll spend a lot of time going over a lot of these techniques together, and we'll do some videos. And I love y'all. See y'all later. Remember, 50% off for life, and we add all these extra data feeds, all these extra tools, trade planner, automatic liquidity map. We've got so many things coming out that are going to blow your mind. Trading alerts, text alerts, everything's going to come to you in this platform. Lock it in now while you can. $100, you're going to be paying $3 down the road. There's no more discounts we're ever going to have this cheap, ever, ever, ever. Build up our client base, support the group, support the community, support developers who love you. Get on over rockscooter.com. Check it out. Get our tools. And you will not regret your choice. I promise you that.